Welcome back, everybody. Amazon CEO Jeff Bezos says that he supports hiking the corporate tax rate. But global companies are also worried about something called GILTI. It's a very ominous sounding prospect, and Robert Frank joins us right now to explain what it is. Good morning. How are you doing, Robert?
Good, Becky. Thank you. You look at these big tech companies like Facebook, Amazon, Apple, as well as the big pharma and the media companies, and they could have a lot more to lose from Biden's plan for overseas profits than they do that 28% rate. And the reason, as you mentioned, is something known as GILTI. That is the Global Intangible Low Tax Income, or GILTI. It's a minimum tax on overseas earnings that was created as part of the Trump tax plan to make companies both more competitive overseas and to prevent them from loading all their profits into the Cayman Islands or other low tax jurisdictions. Right now, the tax on GILTI is 10.5%. Biden plans to double that to 21%. And because companies can only deduct a portion of the taxes that they pay to other governments, the effective rate would be 26%. Now, critics say that would put U.S. companies at a big disadvantage and lead to more inversions and foreign takeovers. Supporters say the current rate is way too low and doesn't generate enough revenue. Now, the Tax Policy Center estimating that Biden's GILTI rate would cost U.S. companies an extra $650 billion over 10 years. That is more, by the way, than the revenue that would come from a 25% corporate tax hike. So, guys, you guys were talking about Amazon and all the loopholes. This is one area where, especially for tech, these overseas earnings are crucial. And we're talking about not going from 21 to 28, but doubling from 10.5 to 21%. So you know the lobbyists are out fighting this.
Yeah, that's really interesting and might explain a little bit more of why you hear Bezos saying, okay, we'd be okay with a higher corporate tax rate. Maybe he's got his eye on things like this instead. How do other countries deal with corporate rates like this? Do they have a similar sort of tax?
It's a complicated question. How do you tax a company's overseas earnings? Most OECD countries basically use a territorial system, which means they only tax the earnings in the country in which those were earned, not when you bring those profit backs. We have a hybrid system where these companies do pay, let's say if they're in Germany, they pay the German government that tax, and then this 10.5 is added on to that. And so, right now, most countries are at an advantage over U.S. companies. That becomes even greater if you double that tax. And that's why it's really important. Yellen has advocated for a global minimum tax. Unless you have all the other countries playing by the same rule and increasing their tax as well, this doesn't work. And this would put U.S. companies at a huge disadvantage.
Shepard Smith here. Thanks for watching CNBC on YouTube.